Hey guys, it's Sasha. Last week, Snapchat reported their results, and after they reported a really bad quarter, the stock fell 30%. But it wasn't just Snapchat that fell. Pinterest fell 8%, Meta fell 8%, even Google fell 4% before miraculously recovering on Friday. And the interesting thing is that all of these stocks fell before they have announced their results. And this is not a coincidence. In fact, the same exact thing happened 3 months ago in July. Snapchat posted disastrous Q2 results and the stock collapsed immediately by 40%, and so did the others. Facebook, for example, fell by 15% just because of Snapchat. The stock then hardly moved at all and slowly moved upwards after Facebook eventually posted their own results on the 27th of July. And the same thing happened back in May. Snapchat fell 40% after disastrous earnings, and all the same companies fell at the same time as well. So you might be getting a sense of deja vu, but there is a very useful observation that I wanted to share with you, some thoughts on what's going on and what's affecting all of these stocks. There is a reason why these stocks have collapsed far ahead of the rest of the market this year. While the S&P 500 is down 21% so far this year, Snapchat is down 84%. Meta, Facebook's parent, is down 63%, Pinterest is down 43%, and even Google or Alphabet is not immune, down 30%. Snapchat just happens to be the first of these companies to report their quarterly earnings, so every time Snapchat comes out with their results, everyone uses it as a proxy for how well the others are going to do, hence why all these stocks happen to fall at the same exact time. So what is the reason for this fall? Are these stocks going to fall even further, and what is the driving force behind the collapse of ad-based stocks? To answer these questions, it is important to note that the primary source of revenue for all of these companies are ads. Each of these tech giants makes most of their money by showing ads. Ads on Facebook, ads on Snapchat, ads on Google, and the ad business is a big deal. 81% of Google's revenue last quarter came from showing ads, mostly in Google search, but also here on YouTube and across the Google network. So Google does make 19% at least of their money from other things like Google Business Apps, Google Cloud, etc. Facebook, though, makes 98% of their revenue from ads. And the thing is, advertising revenue is growing for all of these companies. The rate of growth might be slow, but the revenues are growing. Even for Snapchat, the company whose stock is getting absolutely decimated at the moment. But advertising revenue is a function of 3 different factors. The first factor is how many users you've got on the platform. Everyone has their own way of calculating these: daily active users, monthly active users. What does active even mean exactly? Then there's monetizable daily active users, where some users are not counted for some completely unspecified arbitrary reasons. There's a lot of data being massaged, and this is the metric that everyone has been focusing on, mainly because it's the metric that all of these companies publish in their quarterly earnings. And after COVID arrived, online ads exploded. Everyone was sitting at home, not going anywhere, and there was a boom in people using platforms like Facebook and Pinterest way above the norm, and pretty much everything else on the internet. But then, as COVID went away and became somewhat of a bad dream, the number of active users on all of these platforms has flatlined or even started falling. And this has caused a lot of panic among investors because it looked like maybe the platforms are in decline. They are all going to go and disappear. Nobody's going to use these platforms in the future, when in reality, it was just a reversion to the mean. After some abnormal growth during COVID, these platforms are going back to some kind of steady growth in the long term. Now, it looks like this decline is bottoming out over the last few quarters, and platforms are beginning to grow again at their natural rate. And some investors might get very excited about this, but remember that there are 2 other critical metrics, and these metrics are not shown in these quarterly reports, which is why nobody tends to talk about them. These metrics are the level of engagement per active user and the cost of running ads to these users on the platform. Because ultimately, the revenue from ads is a multiplication of these 3 factors. The number of active users times the level of engagement per active user. How many pages do they see? How often do they come back to the app? How long do they spend on the platform? Times the cost of each ad impression. Because the more engagement you have as an active user, the more ads you are going to see. And each time you see an ad, there is a company paying for that specific impression. Now, We know that each of these tech giants is doing everything they can to increase engagement. That is something sort of within their control. The world is becoming addicted to opening up social media 10 bazillion times every day, so although we don't have any robust data, you would expect that engagement levels per user are probably doing just fine. But then we have the last factor, the cost of ads. And this is the most difficult factor to analyze because there just isn't very much good reliable data out there. It is also potentially the most important factor because the first factor, the number of active users, is generally doing alright, slowly starting to grow again. The second factor is also doing okay. This is the factor that is really affecting the revenues. Here is some really interesting anecdotal data. I started my YouTube channel in March 2020 and I started earning money from this YouTube channel from the ads in August 2020. And the type of content on the channel has been really quite consistent through 2021 and 2022, and you can see what's been happening to the CPM. CPM is the cost per 1,000 ad impressions. So for every 1,000 ads shown before this YouTube video, YouTube will earn $19.18, and I will get $10.58 out of that on average. Now, I have a finance channel on YouTube, so my data is not at all representative of the average. Finance channels tend to get considerably more money spent per ad because a lot of the ads are related to finance. So there is an industry bias for sure, but you can see that ad rates have plummeted since peaking in September, and the relative movements are somewhat interesting. You can see for me that the ad rates are about 2 to 3 times less today than they were a year ago. And this does make sense if you think about it. We had the boom in online advertising during 2021, and this year we have had high inflation, the stock market crashing, the global economic crisis, the global energy crisis, the cost of living crisis. Companies are tightening their budgets and are more careful with spending money, including on ads. Now, I went and had a look at a bunch of other content creators, some much bigger than my channel, doing updates about their earnings on YouTube, and the story seems to be much the same across the board. Ad rates are in a steep decline, but here is some more anecdotal data. As well as doing YouTube, I also run some websites, and here is the same ad rate data for one of those websites. Now, ad rates are very seasonal. Q4 is always the highest earning time of the year with Black Friday and Christmas spending, and Q1 is always the lowest. Hence why you get these massive drops every time you go from December to January. But if you overlay this year's data over last year's, you can see how the ad rates have started to decline more and more as the year progressed. This time last year, the average RPM on the website was around $42, and now it's around $34, a drop of almost 20%. Again, the data is highly anecdotal. It is not representative. It is in one specific niche, blah, blah, blah. But speaking to a bunch of people who operate some really big websites, again, the picture seems to be much the same across the board. So what does this mean for companies that make their revenue from ads? Well, first, remember that not all companies that do ads are the same. Companies like Google and Facebook have been doing this business for a long time now, and their businesses are highly optimized in terms of how much you can squeeze out of advertisers. Facebook published their revenue per user data every quarter, and you can see that the overall revenue per user is declining because of the data I just showed you. And when the results come out in the next few days for Q3, I am guessing we will see an even steeper decline for ad-based companies if my anecdotal data means anything at all or is in any way indicative. But when you look at the breakdown, it is even more interesting. The most developed and established markets are seeing a very big decline. US and Canada went from $53.01 per user in Q2 last year to $50.25 per user in Q2 this year. Europe fell from $17.23 to $15.64 in the same period. But the less mature markets are still growing. Asia Pacific and rest of the world revenues per user are up. And this is because these markets are still in the developing phase. Ad rates are still significantly lower than they are in the US and Europe. The providers of services and goods in those countries have not been squeezed to the maximum of what they are able to pay for advertising. The economies of those countries are still in the developing phase and growing. So these markets are all growing for companies like Facebook despite the decline in average ad rates because they are still so far behind. But then you go and look at a company like Pinterest. Same kind of business model, but where Facebook makes over $50 per user in the United States and Canada, Pinterest made only $5.82 last quarter, 88% less per user than Facebook. And some of that difference is going to do with the difference in the platform, a difference in the engagement. People might browse Facebook for much longer than they will with Pinterest. But a lot of it is also down to the ad platform on Pinterest being significantly less mature. They've only really started pushing the ad business relatively recently. The company just hasn't developed the level of sophistication, the insight that Facebook has with targeting ads, and Pinterest doesn't have as many advertisers on the platform competing for the eyeballs and driving up the price yet. And this is why you can see that while Facebook's revenue per user is dropping, Pinterest is increasing over the same time period. Q2 revenue per user in the US and Canada is 20% higher this year than it was last year. And this is because the platform is growing despite the drop in advertising rather than dropping because of it. Now, the million-dollar question is, when will the trend reverse? When will companies start feeling more optimistic? When will they start spending more on ads again? You can see that ad rates had two hits specifically this year. First, when Russia invaded Ukraine, there was a massive load of panic. Rates went down immediately, although not as much as you would think. But then the sentiment really started shifting in late April, when ad rates this year started to suddenly fall a lot lower than last year. Now, I don't know when companies will have the confidence to start investing heavily in growth again. The Fed is meeting again next week, and we're going to probably get another major rate hike. It is very possible that the Fed will continue going at the rate hikes, maybe going much harder than what everyone, including Wall Street, thinks, and keep raising rates until inflation is fully under control. And the question is, if we do get to that point in Q1 or Q2 next year, in just a few months, if it looks like inflation is starting to come down and the central banks start walking the rates back down slowly as a result as well, if we get some kind of a resolution on the Ukraine conflict one way or another, something that makes the markets more comfortable with the long-term future, if Europe makes it through the winter without blackouts because of gas shortages, if some of these things happen, it is quite possible that the doom and gloom that everyone is predicting does not quite happen. And as the doom and gloom reverses, companies seeing a bright future might start turning on the spending taps. You see that back in 2020, when COVID first arrived, we had a few months of suppressed ad revenue because there was widespread panic. But by June, companies started spending big money on advertising again, bigger than before, because they began seeing the green shoots and online spending started to boom. And the good news is this shift from panic to big spending can be incredibly fast. In 2020, ad rates went up by 100% in about 1 month. And at the moment, everybody is panicking. Everybody's predicting a complete collapse of civilization as we know it, because, the Great Reset, the World Economic Forum controls everything and everyone. The Illuminati are busy installing the New World Order, blah, 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 conspiracy, tinfoil hats, but things can change. I don't know when they will change, but what I do know is that when they do change, because they will change, they will be an absolutely massive opportunity for some of these ad-based companies. This is why I personally own shares in Pinterest and Google. The potential benefit to these companies whenever the bounce back really hits is likely to be significantly above average for the market, just like the hit this year that these companies experienced was also significantly above the average. Because you can see how vast the difference in ad rates can be, and this difference will go right into the revenue line for these companies. If you found this video useful, please don't forget to smash the like button for the YouTube algorithm. Thank you so much for watching, I really appreciate it, and as always, I'll see you guys later.